Hello, everybody, and welcome back to the show. I'm the host, Jeff Newman, and today we have the pleasure to speak with Simon, and I'm going to say your last name, Nakara. Is it
No,
Nakara?
no, no.
Nope.
Not Sheila.
Thank you so much. And Simon is with Lumen Global Investments is the name of the company. And so, Simon, welcome to the show. And to kick off, tell me, what are you guys doing over at Lumen Global Investments?
Thank you very much for having me. Again, it's not Sheila, it's an Italian last name, but in English, everybody calls it Nocera. So just a quick credentials. What we've been doing, well, we've been in the market for about 30 years between one thing and the other. Lumen, our company, is a small partnership, has been in existence for pretty much 20 years. It's a good group of people. We've been together essentially since 1994 to start with, but at Lumen since 2000, year 2000. And what we have been doing, what we've been busy over the last 3 to 4 years, essentially since the pandemic, is building up a platform in an engine, coding technology and whatnot, that gives all of the various tools to build up portfolio, bespoke portfolio, customized portfolio, literally from the beginning to the end. From the beginning, meaning, idea generations, to organizing those ideas, to objective determinations, to organizing everything into an efficient portfolio, and then managing the risk and the stress testing and the probability of being successful. It's been fun. There is a lot of good reason why we have been doing this. I hope we can go into detail, and that has more to do with the way the market has developed. In particular, I don't know if I can go into it straight away. I don't know if you have other more specific question to ask to start with. But as I was saying, let me start it from the beginning. I started up my career essentially teaching economic at the University of Milano, where I graduated. Worked after that for 2 years with the European Commissions in Sub-Saharan Africa, advising on economics and whatnot, and then the IMF for about 11 years. And then I moved into the private market. Why? Because you must have heard and you must appreciate the term of armchair economist. As an economist, working for government organization or academics, we did all sorts of analysis, predictions, forecasts and whatnot. We never paid the price, right? Whether we're right or wrong, it didn't really matter. The next day you moved on to a different type of theory, so to speak. And so I realized early on that, one great way to actually see whether or not economics actually works is to be in the market, because the market is one of those things that really keeps you sharp, because every single day you come up with predictions and whatnot. The next day you open up the newspaper, you know right away if you're right or wrong. And so that was a fantastic teacher, if you wish. And so if you're a student of the market, I thought leaving academic and leaving government and moving into the market was probably the best decisions I've ever made in my life. Professionally, very, very rewarding. And as I was saying, I've been doing this for 30 years. And one thing that I've learned, and one thing that the market has taught me very, very quickly and continues to teach me literally on a day by day basis, is that the market is very efficient and it's very difficult to beat. Let me give you a number that I always love to quote, and a lot of people really don't realize that 98%. 98% is the percentage of active money managers in the US and worldwide is even worse, that do not beat their benchmark. In other words, you invest with them, you lose money relative to market. You would be better off investing into a passive fund or into a benchmark or into an index and whatnot. Why? Not because people like me or like us or my counterparts have lost their cognitive capability. We still are able to do exactly what we used to do 30 years ago. It's just that the market has changed completely. Again, it has become very, very efficient. If you think about it, because of technology, because of very cheap telecommunications right now, marginal costs are literally zero. I mean, look at us. We are on a video. You're sitting in New York. I'm sitting in San Francisco, and it's as if you were next door or whatsoever, right? And a huge amount of data availability for almost for free. Think of Yahoo, for example, Yahoo Finance. I mean, you can get information on every single stock. So what happens? Given all of this set up, anytime there is a piece of information that is very important and relevant for a stock, a bond, or an investment ideas, it gets broadcasted immediately for literally at zero marginal cost in all four corners of the world and gets arbitraged and embedded into the current price very, very quickly, immediately, instantly. And, there's a famous book by Michael Lewis. I'm sure, your audience know him, about the fat fingers of Wall Street and, how they actually exploit all of this type of stuff. And it's very, very difficult to exploit. But the point is that in this type of environment, the single individual active manager is very difficult for him or her to actually beat the market. It's literally impossible. I mean, as I say all the time, I got more technology, data, and capability information in my cell phone in the palm of my hand that I used to have when I used to work at Soros. A lot more. So given this environment, market have become very, very efficient. Now, there's kind of nothing new in a sense because, you have to go back to the 1900 with Bachelier that, was talking already about the fact that markets were a random type of situation. And you have Eugene Fama, the academics that were telling us already that market were efficient already 20 to 30 years ago. It's just that the technology, telecommunications, and data availability has made the market efficiency even more apparent. So in that kind of environment, it's kind of useless to try to beat the market by picking stocks or picking bonds or whatnot. And it's getting even worse. It's even worse if you think about it in what people call alternatives, hedge funds, credit, private equity, and whatnot. Hedge funds, you look at the various performance numbers, the various indices and whatnot, they're way below, for example, in terms of returns, a simple returns on the S&P 500, simple passive type of strategy, passive type of vehicle. Same idea for private equity. Private equity, I published a paper, I don't know if your audience would be interested, in which I went to, it's not even a paper, I call it a book report because, I collected a whole bunch of data and said, look at the situations, don't listen to my opinion, look at the situation. And so it comes out very clearly that 2/3 of the returns of private equity were primarily because of financial engineering, leverage, so to speak. So what happened? In 2022, when interest rates all of a sudden went up, private equity started to collapse. And now you see all of the problems that are affecting also private credit. I don't know, again, if you're following what's going on in that part of the market. And again, it's an insidious kind of vicious type of evil, I would call it. Sorry, that's my Don Quixote view with Wall Street and whatnot. That's a kind of evil type of situation. You have all of this master of the universe, essentially, sitting on the big board of endowment, university, foundation, pension funds, and everything. Putting money into private equities. Then the private equities, need finance, so they create the private credit. And then now they want to give the private credit and private equity to whom? The case guys, I mean, the pension funds, the retail market, in other words, because their funds are doing very, very poorly. All I'm saying is, again, it's not necessarily because of their fault. I mean, they're exploiting, a little bit of ignorance, if you wish, on the part of a lot of institutional investor and retail investor. But the market has become extremely efficient. Let me summarize it for you, one number. In 2020, just because we had plenty of time because of COVID and whatnot, we actually went, myself and my colleagues, my partners, we went and collected a whole bunch of numbers and data. And we find out in 2020, the American investor paid or spent $180 billion in management fee to active manager in order to lose money 98% of the time. That really does not make any sense. And if you look at the situation in the rest of the world, it's pretty much the same. You look at Europe, that number 98, and that number 98% is quoted and done very, very professionally determined, if you wish, by one of the S&P company, S&P IVA is called. And they've done the very same thing in Europe, for example. And in Europe, they find out that, it depends on the fund, you could be between 90 to 93, 95%. But in my own country, Italy, it's actually 100%. So people are paying through their nose in order to have the illusions of investment advisors and whatnot. And its own entire system is generated through trading. Another thing that I continue to say, people need to make the distinctions when they look at the situation and condition in the market between what they want to do. Do they want to be traders or do they want to be investors? Because those are two very big differences. The trader is, for example, the person that buys low and sells high. Whatever happens in the middle, a war, the weather, cold in New York City, warm in San Francisco. So what does that mean for oil or whatever? And so they don't really have an investment process or philosophy behind it. An investor, on the other hand, is somebody that buys in order to enjoy the cash flow that that investor generates. The very famous investor that everybody quotes and nobody copies is Warren Buffett. That's what he does, and that's what does all the time. So you can imagine in that kind of environment, where is the advantage of the business model of all of the big trading houses? Trading. So they're incentivizing you and the manager and the retail to trade all the time, every single day. I don't know if I'm going all sorts of directions over here, Jeff. So maybe you should bring me back to reality.
Simon, that's great. No, I really appreciate all of this. And yeah, I guess for the listeners, not financial advice. We're just we're telling stories,
Mm.
giving introductions. But so Simon, your career is amazing. Your history, you're in San Francisco today, but you said you were a professor in
Yes.
Italy. Yeah. You could fill in any gaps you'd like in between that journey if you'd like. But I guess, my next question, in addition to going backwards and how you got here today, is what are the type of customer project profiles that excite you, that you're proud of, that
Mhm.
differentiate you? And without giving away private information, if you wanted to share a story about a customer solution or some type of work you're doing to where maybe a listener could say, this sounds like me. Because it would be interesting to tell a story where also you attract your next customer who says, if you could help them, I'm sure you could help me. And
Right.
again, without private information, what is a kind of a situation that's your zone of genius that makes you uniquely qualified to help people?
Yeah, we have spent the last 4 years digitizing, or I don't know how can you say it properly, investment engine, providing all of the tools necessary to build customized portfolios. The mission, if you wish, or the visions, whatever that is to actually bring to the typical type of retail customer the same type of high quality portfolio and high quality analysis that people actually provide nowadays to institutions with a very, very low cost because we exploit technology and whatnot. We are exploiting obviously our 30 years worth of experience, but we're also exploiting what I was saying before, that the market is actually very efficient. So one thing that, for example, we do not do, we don't forecast the future. I found that a very expensive exercise of overconfidence. We actually dissect the present, which is much better. So what can we do with that? We have created a system of said, I'm sorry, Jeff, but I'm gonna, it's not a matter of giving you secrets and whatnot. Everything that we do is super transparent. It's on our website. Everybody can actually see it and whatnot. But I need to get into the technical details in order to actually make sense. You remember that 98%. So what we did, we turned that situations around and we say, okay, if the manager are wrong 98% of the time, that means that the market is right 98% of the time, right? Makes sense. So instead of finding the market, let's extract from the market the implied expected returns. We've done that and it works beautifully. But the point is, what can we do with that? We are actually able to rank the entire global system, global financial market, across countries, across asset class, bonds, equity, commodities, real estate, and whatnot, across what people call factors, growth, value, quality, low volatility, and whatnot, across teams, across ETF. And so what can we do with all of that ranking system? We can extract from that subset of investment ideas that actually meet people's objective. And that's another big mistake that people make whenever they go to the investment. They don't really have a clear mind of what is their objective. They want to make money. Well, everybody does, but why? Do you need it for to preserve your capital, to create income, to have growth in the next 5 years or in the next 50 years, or pension, whatnot? Very important. So by finding this, by again ranking the entire market based on the intrinsic value of decided by the market, implied by the market, and finding out always subset of investment idea, investment solutions that actually meet the objective. By definition, constructions, you realize, hey, Jeff, I'm sure you can appreciate, we actually have a much better, probability of actually meeting the outcome and having better performance. And you can do that Exploiting, as I said before, data technology, not necessarily the cellular phone, but, even AI, we can go into that, what we're doing with AI and how we're using AI if we have time. But you can do that with all of the technology and data available to you right now, which means what? Very, very low cost. So our vision in terms of who is our best customer, as you were asking, is the rest of the world. I mean, it's literally people that are in need of investing. I'll tell you even more. I mean, maybe because of the old age and a bit not whatnot, you like to feel about some sort of legacy and whatnot. We all know that the world has a pension problem. Anywhere you look at it, and anywhere, all of the countries that I visit, in my career with the IMF, prior to the EU in South Africa, and now with global market, everybody's in a pension problem. So you're going to have to take care of your own private savings. And the way to do it is definitely not the way to lose more than 98% of the time and paying $180 billion or whatnot. Again, I don't know if I answer your question properly, but what is our best investor, our best customer is everybody that really needs to have a, a honest advice in terms of investment, in terms of portfolio constructions, in order to take care of their savings and their future.
Yeah, that makes sense, and I appreciate you, acknowledging the pension problem globally and how that's, a challenge that needs to be worked on. You mentioned AI, if you could, just a timestamp, it's March 2026, so we're in the first quarter of the year 2026. How are you using AI, and do you have, like, a five-year vision of if it's transforming your business or even an industry that you have your hands on?
It's transforming the business for sure. There is no questions. But in which way? People think, and I've seen it used, and there are some people appreciating the market actually making noise about it. They believe that AI is going to be great in order to predict the future. And so clearly, the immediate application is, oh, let's apply it to the market. But that doesn't work. We know it for a fact. But instead of using AI as a predictor, you can use it as a sanitizer, as something to sanitize the input of your entire system. AI has made our job and our analysis, if you wish, a lot faster, a lot more precise, in terms of cleaning up the data, in terms of matching the data with, for example, the global backdrop, or telling us, what kind of environment are we in what kind of regime in terms of life cycles of the investment, of business cycle, of life cycle, whatever that is. So it means that we can do our job with a lot less human resources, no question, and a lot more precision. Not again to forecast the future, but to dissect the present, as I said before. That's what we do typically. Now, having said that, and that means essentially, Jeff, that instead of having, I don't know, 5, 6, 7 analysts like we used to have before, we only have a couple. And with a couple, we are actually super productive and much better than before. I can give you some very silly examples. Being a non-English speaker and having to write reports on the market for clients all the time, that was always a challenge. The weekends have always been allocated to me try to write in English some good reports. Now my weekend are easier because I write down something very quickly, put it onto AI, and it gives me. It's a great editor. So I don't have the money. I don't have to spend the money to pay an editor. I can pay AI. I mean, that's one simple anecdotal evidence on how you can use it. Now, having said that, do I have a vision of the world as dystopian as the famous report that came out 2 or 3 weeks ago? With 15% of the job in the U.S. disappearing. I don't believe so. And to make it, in very, simple way, it's an increase in productivity. There is no question. So as an economist, I know very well that at least 50% of the growth since World War II was because of increase in total factor productivity. So what does that mean? It means that the pie is going to get bigger. It means that we're going to grow a lot bigger. The key question is how we're going to split that pie. This is a key problem. And, there is very simple solution. In the US, for example, again, I don't have a dystopian view. Why? Because if the idea is to split the pie much better for all of those people who are going to be displaced by AI, then one thing that you can do is through, the government, obviously, through various social programs and whatnot. Can the government afford it? If we increase taxes, absolutely. And why would we not increase taxes given that the pie is getting bigger? And the US, as you probably know and your viewers probably are familiar with it, is the country with the lowest amount of taxes as a percentage of GDP compared to all of the other developed countries. In Europe is 50, 51, 53%, like in France. In the US, it's barely 30%, 28, 29.
Yeah.
So there's plenty of room over there, in other words, to use that as a equalizer for the disruptions that AI is definitely going to bring.
AI is an interesting one because it's you talk about the connection with energy and infrastructure and how
Um,
there's a talk of opening up nuclear plants to power the AI and have the companies make sure they offset the electricity. But then you even have
oops.
people talking about I don't know if you know Andrew Yang and
No,
universal basic income.
well, I don't know him very well.
He says, "Why don't we tax the AI agents and tax the AI and stop taxing the people for income?" You know, and so that's an interesting idea, whether it happens, but it's an interesting conversation for the society is if the productivity of AI is so big, why doesn't the AI, the machines get the tax and not the human labor? It's
Correct.
interesting.
Correct.
Yeah.
That's my point. And the point again, there is room, especially in the US, to actually do that. The US is different from Europe. It's not a social democracy, to be clear. Europe has a lot more emphasis on the social safety net. So there's an automatic stabilizer in terms of what AI is going to do and how AI is going to be, the AI advantages are going to be distributed across the people. In the US, we're not there yet. So I hope we get there. You need to have a proper political capital. Somebody wants to do it.
Mm. Yeah.
We're not there yet.
This is helpful. What's your vision for 2030? Your business, you're helping your clients, getting yourself there successfully. Not that the world ends at 2030, but as a 5-year mountaintop.
For the business, I think we are very, very excited, again, because for my business in particular, right? And from the market as well, because things are changing fairly rapidly. I was in a roundtable, 2 days ago, a few weeks ago, actually, in which people were saying, were lamenting that, diversification, all of these people, these are registered investment advisors, people that advise other people in terms of what to invest and whatnot. And they were saying, for example, they were lamenting. They say, we all know that diversification is the best way to manage risk in a portfolio. You need to diversify. But in the US, it's become more and more difficult because listed stocks, for example, have gone down from 8,000 to 3,500, 3,600. So they cannot diversify. And so the solution was, oh, we're going to move into private equity, private credit, and that kind of stuff. So I made a fool of myself when I said, well, that's good idea, great idea, because you got a lot more private equity than listed stocks. In fact, I said in the U.S. you got more private equity fund than McDonald's restaurants. Just to give you some perspective of where things are going. But my point is that the market is becoming more and more aware of the possibility that technology is actually offering you. And there's a brand new approach to portfolio management. It's called total portfolio approach. I don't know if you're familiar with the old way, strategic asset allocation, the 60-40, 60% equity, 40% bonds. And people use that as the base and then they tweak it up and down depending on, how they see your risk profile with a couple of questions and whatnot. That worked very, very well because interest rate collapsed or yield collapsed from the 80s at 16, 18% all the way down to zero. But now they're at 4%, they're not going to go back to zero. And in any case, they're not at 18. In other words, the fixed income component is no longer going to be a source of returns. It's going to be a diversifier at best, and if not a source of. So there's a new way to do it, which is called total portfolio approach. And total portfolio approach works instead of separating the world into silos, equity and bonds, so the 60-40. So you decide how much equity you want, 60% of your portfolio, you give it to a manager, that manager goes off and manages versus a benchmark, irrespective of what happened with the rest of the portfolio. So the portfolio approach does something entirely different. They say, okay, first decide your objective. And if your objective is growth, you're not going to achieve by simply dialing up that 60% to 80%. You need to find actual growth stories all over the world, not just in the US, not just through the listed stock in the US and whatnot. So every single position in your portfolio, including bonds, has to reflect a growth perspective. And so by definition, again, as I said before, you increase the probability of actually meeting those returns. So if you remember, that's exactly what we've done. So we have pioneered pioneered and digitized a system called Total Portfolio Approach, which I urge everybody to actually check it out on the press. It's becoming very, very popular on the press. All the financial press is on top of it. The big investment powerhouse, GIC, Temasek in Asia, the Australian Superannuity Fund, and now CalPERS, which, as you know, is a trailblazer in terms of pension funds and everything, through this new gentleman, Gilmore, they actually are implementing this system, total portfolio approach. So we feel extremely good because we have a ready-made product, digitized. It's the entire tool that has pioneered this system with fantastic results. So we just finished everything. We're finishing up all of the last touches in terms of how we apply AI. So we feel very, very excited for the next 5 years, 2030, as you mentioned, for us, but also for the market, because as I said, the market is becoming more and more efficient. People are realizing that it's silly to spend $180 billion to lose more than 98% of the time. As they said, let's look for other alternative. If Cat Perry is doing, let me find somebody else who's doing it as well. So it's moving. So super excited.
That's great. Simon, that's really well said. I appreciate you saying pioneer, trailblazer. Like you've
Good
answered
one.
the what is the differentiation? What do you offer that no one else does, and the culmination of your perspective and career. As we're wrapping up, my last question is, what did I not ask that you want to share that's related to this?
Ooh, that's me more than you asking. I said everything I wanted to say. So I think, we didn't touch about my global perspective, which, and where I came from, where I was born and whatnot. And so that's super, super important because no matter what, that 98% is also functions of the fact that there's been huge amount of global liberalizations on the finance side and innovations. So one of the advantage that we have as a group, all of us speaks each of us speaks two or three languages at least in the partnership, and it's six of us. We come from all sorts of different parts of the world. I personally visited pretty much all continents except Antarctica, and lived in four of the continent directly. So the global perspective is very important for one simple reason: diversification. That's the best way to actually manage your risk. Is the what people call the free lunch in finance. Instead of saying, US equity are disappearing because there's only 3,800. I'm going to buy one of those private equity funds with the same bigger than the number of McDonald's restaurants. Look for the rest of the world. Look at the rest of the world. Don't be parochial. So I guess that's one of the aspects of our company, or myself, I don't know if I can say that, that has actually naturally led me to do the things that I've done.
Simon, this has been a pleasure. It's been very interesting.
Thank
Thank you for your time. And before we wrap up, where can people find you? What's your preference? Is it a website, an email? And anything you say, we'll put in the show notes in writing. But if there's a place that's a preference of most likely you'll read it. If someone were to reach out on a LinkedIn or email, where would you read and respond to someone new that wants to work with you and
Our
ask?
website is actually fairly descriptive. It's totally transparent. As I said before, we don't have any secrets. We tell everybody what we do very clearly. And so you'll find all of that information there. You'll find plenty of videos to explain what we do, how we do it. You'll find some information in terms of actually predefined investment strategy and whatnot. It's, can I say it is www Lumen. So, and R4A stands Robo for Advisors. Not very imaginative, but the name stuck already a long time ago, so we left it there.
That's good. The URL is available.
Yeah, yeah.
Simon, wonderful. Well, thank you so much. Have a great afternoon. And again,
Thank
this was
you very much.
great stories and insights, and I appreciate your time. So thank you. And
Thank you very much for inviting me.
thank you. And folks, we'll see you next time. Have a great day.